Hello everyone and welcome to another financial analysis video. My name is Ted Wayman and today we are going to be looking at a company called MicroStrategy. Okay, so first of all, MicroStrategy, what do they do? Here we go. They're incorporated, the United States company that provides business intelligence, mobile software, cloud-based services. They develop software to analyze internal and external data in order to make business decisions and to develop mobile apps. Okay, so that's the company, and today what we're going to be looking at is the financial analysis. So we're going to be looking at the financial statements of this company. Okay, so this is a request from one of our viewers. So here is Alex Dunstan. Here is your video. Can you do MSTR? Hopefully MSTR is MicroStrategy. I think it is. So this is your analysis. So once again, if you're new to the channel, then please don't forget to like, share, and subscribe. In fact, if you're not new, then do like and share these videos with your colleagues. Do subscribe to the channel so that you get a notification of the latest videos as we're releasing them. We're trying to release one or two a week at the moment. If you've got any companies you want us to look at, then please do leave that in the comments box as well. Now, this analysis is just going to be the financial statement. So we're not going to be looking at the company, the strategy of the company, the market it's in, the key success factors of that market, etc., etc. So that's all information which you would need to do yourself. This is complementing that as a fundamental analysis. So all we're going to do is look at the financial statements, and what I'm hopefully going to do is to kind of show you some of the information and the story that the numbers are providing, and you can decide whether the story that the numbers provide stack up with the story that the management is providing or the market or other investors are providing. Okay, so that's all we're trying to do here, is to give you a little bit of insight into the financial statements. So with that in mind, here are their financial statements, Form 10K, and we have to scroll all the way through to well, right down to significantly into this in order to find the actual numbers that we're looking for. So the first thing we're going to do is go and find the income statement. So here is the income statement of our business, and we notice that we are dealing in dollars and in thousands of dollars. So the total revenue for this company is $481 million. $481 million. And you'll notice that they've actually split this out between product licenses, subscription services, product support, and other services. Now, what they've done here is that they've then taken from the revenues, they've looked at the cost of generating those revenues. So this is known as the cost of sales or cost of goods sold sometimes. And what we can do is we can actually analyze on a line-by-line basis. So for example, the product licenses were sold for 86 million, but they only cost 2 million. So you can see that those product licenses is very, very profitable. I use a different color to show the subscription services that they offer, 33 million, and the cost of those subscription services, 14 million. So you can see that that's about a 50% margin. Use another color now for the product support that they're offering is substantially the biggest part of their revenue, 285 million, and the cost of that product support only 24 million. And then finally, all of the other services, almost running out of colors here, the other services, they make revenue of 76 million, and the cost of providing those other services is 50 million. So every single item is running at a profit, and the gross profit margin, the overall profitability of this business, which is this 389, basically 390 million, they're operating at an 81% profit margin, 81% profit margin. That's basically says for every dollar they bill, it costs them 20 cents to provide that service or to provide that product, and they get to keep the other 80 cents. So this is a very, very high margin business, very, very profitable indeed. Scroll down a little bit though, and what we find is that in terms of the operating costs, there's some very high operating costs. So look at all these operating costs. Sales and marketing, very high costs in sales and marketing. They are investing in the future. That's the research and development. The general and administrative, so these two numbers together, the S, G, and A, typically as they're known, and there is some impairment going on. So they're taking a big hit in this year on digital asset impairment losses. So this will be a sort of, a one-off hit. You'll notice that those didn't happen in previous years, and so we'd expect them not to happen in the next year. So our summary is that this is a profitable company. They're booking a loss in this particular year. The reason for that loss is this one-off impairment. Without that impairment, they would have been making a $63 million profit. The other thing to notice here is that they're paying tax, and there is a little bit of, there's this other interest income or expense. So in previous years, it's been a pretty positive number, and in this year, it was a negative number. Now, there's nothing giving us any more information on the face, but that's, those are fairly significant numbers to be sitting so far down in the in the other section. So what's our conclusion here? It's a company, it's made a loss, but fundamentally the underlying business is very, very profitable, very high margin in terms of the product that they're selling, really, really high margin, and big investment going on in R&D, which will be all about protecting those margins going forward, so that they're providing the best possible product and the best possible services. Let's go look at their balance sheet and look at how, the strength of this company. So here is the balance sheet. So we notice here, first of all, these are the non-current assets, so the things that we need to run the business. And the thing that jumps out at us is this digital asset. So you remember they did this write down of a digital asset, even though they've written it down. It's a new acquisition. And it is $1 billion, basically. They spent $1 billion on this digital asset. Here up the top, we've got the current liability. The current assets. Here are the current assets. Current assets have fallen significantly, and the reason is for their fall is that this cash has gone down significantly. So the cash has fallen. Now they're operating at a profit, and if they're operating at a profit, they are probably generating cash. We'll confirm this in the cash flow. So it looks to me like some of that cash will have been used to buy this asset. Okay, and that's the reason that the cash has fallen significantly. Even so, the current assets, if we compare it to the current liabilities, it doesn't look too bad. It's less than the current liabilities, and that might be a warning sign for us from a liquidity point of view. But actually, when we look at the current liabilities, we see 191. This is deferred revenue. So these are customers, and the customers who are paying subscriptions, they're paying to MicroStrategy up front. MicroStrategy is saying, I'm getting the money today in this year, but it relates to next year, and therefore I owe it to next year, so it's sitting as a liability. They don't have to pay it to anybody, so it's not going to affect their cash flow. In fact, it has a positive effect on the cash flow because they're getting the money in today. So I'm expecting, when I look at the cash flow, to see very strong cash flow coming in, and liquidity is not a problem because of the strength of that cash flow. Nothing else that really jumps out at us on the balance sheet, only to apart from, let me just clear all these annotations so we can see it very clearly, that these guys have a whole lot of debt that they didn't have there previously. Okay, so suddenly there's quite a lot of debt sitting on the balance sheet, and it looks to me like they're using that debt. So they're probably using a combination of debt and cash to buy these digital assets. Okay, and that's effectively, we'll confirm that through the cash flow statement in a minute. Down the bottom, here are just looking at the shareholders' funds. Interesting enough, so these two numbers, this is the what they've raised and invested. This treasury stock, interesting enough, this is own shares held. So this is actually the repurchase of their own shares. So in MicroStrategy, they're obviously generating cash, and they've been using that money to buy their own shares, maybe rather than repay or to pay any dividends. So that's quite an interesting feature on their balance sheet. And they have retained earnings, so they have been making profits in the past. Go through to this movement in shareholders' funds. So we are interested in this retained earnings in this line here. We can see that there's the profit from a couple of years ago, the profit from last year, the loss from this year, and they're not paying out any dividends. So there's no dividends going on in there, but you will notice that the treasury stock, they are buying back their own shares. So in effect, what this is a way of returning money to the shareholders. Rather than using a dividend, they're buying back their shares. Therefore, the value of the shares is going up. So you're making a capital gain on it. People who have share options, especially the staff, are seeing their share options, rise in value. So that's a benefit to them as well as the senior management. Okay, so we can look upon these numbers here as a kind of as an alternative to dividend payments. Let's go look at the cash flow and see how the cash flow is looking. So here's the loss up at the top of the cash flow. If you remember, there's the loss that we made and the profits in the previous year. And then for the actual cash flow, we are generating cash. So from 10 million in the a couple of years ago, 61 million in this year, a little bit down on that to 53 million. But very, very, very strong cash flow coming through. And that's going to be a combination of the fact that the loss was due to the write down in a digital asset and the fact that they get a lot of their revenue up front or in advance of providing that service. So that's coming through very, very strongly. Let's look at the bottom half of the cash flow and see what it's telling us. So here we can see the purchase of the digital asset. You remember that's the purchase price. And that they have, effectively they've written a part of that down. There's the debt. So the proceeds from the debt. They've also issued. They have issued some shares, also some senior notes, some more debt, but it's classified as equity here. They've been buying back their shares. And so in effect, they've been raising money. So they've been using effectively the cash that was sitting on the balance sheet at the end of last year. So the cash has been used to buy that digital asset. The debt has been used to buy that digital asset. And they've also been using some of that in order to buy back their shares. And they are generating a reasonable amount of cash as well. So cash at the end of the year, 60 million, doesn't look too bad. It's not as much as the previous year, but then you could say that the 457 they had was probably a little bit too much. So there are the financial statements. So let's go back to the business and look at the share price. So if we look at it over the history, we can see that actually there was it obviously sort of launched and we can see this was very much getting caught up in the dot-com bubble and then bursting, and so really we wanted to sort of focus in on the more recent developments. So let's hone in on the kind of the latest set of figures. So this is for the year. So the company, we can see that, and I guess that this is kind of somewhere around the digital asset being purchased around, the digital purchase during the year. So company sort of obviously got quite ahead of itself, and then is trading pretty much in a kind of in a straight margin here. No P ratio because it wasn't making any earnings. But if it did have that, if we did calculate the P ratio, if we kind of calculated the P ratio, I guess based on earnings, less that less the write down, the underlying asset, underlying earnings, ignoring the asset, then what we would probably be looking at is a P ratio of about 100 times. Okay, so quite expensive on an earnings basis. It's all goodwill. Okay, so 6.13 billion. The balance sheet is only 500 million, yet this is a company that has very, very high margins. And if it can grow and it can continue to grow, and sales were, they were down 1% in 2020. So, it has come off the boil a little bit, but it's only trading on 13 times sales, very high margin sales. So if the company can start to accelerate and continue that, then maybe this valuation doesn't look so unreasonable after all. Okay, so it is expensive. There's a lot of good news in this company. It looks like the good news is reflected in the price. It's not a screaming buy, but it's not a screaming sell either. I wouldn't say avoid it like the plague, but I wouldn't say fill your boots necessarily. So there we have our financial analysis. I hope you found that useful. Just getting a feel for the income statement, the balance sheet, the cash flow, the movement in equity, how they're all talking to each other, the information, the story that we're getting through the numbers. Please do like, share, subscribe to the channel. Do leave your comments, any additional information about the company, and do please let me know if there are any companies you'd like me to look at. Otherwise, I will see you in the next video.